Thanks for journeying into Bayesville, where we're going to be talking about posterior predictive levels. Quick background on myself, so you have an idea who is talking at you today. So my name's Luke Miller. I 30 years experience building Bayesian learning algorithms, and recently I've been pretty excited to roll AI into my methodologies. I have a full career working in industry, and I consult companies like Morningstar, MMR, American Express, Pepsi, Amazon. And what I'm doing today is I'm bringing some of my work that I do institutionally to the retail market. So quick agenda for the day. We're going to start with what are PPLs, Posterior Predictive Levels. Then I'll do a historical perspective on trading indicators, how the PPLs are calculated, and then I'm going to show you some examples on how you can improve your trading using PPLs. So what are PPLs? Well, first off, they're calculated using AI Bayesian learning algorithms. So what does that mean? Well, Bayesian mathematics has been around for a long time, and it's a way to quantify and objectively determine the probabilities of success or the probabilities of the learning process. Now, when it comes to the PPLs more specifically, you would treat a PPL as you would any other support or resistance level. You're going to take profits on longs heading into resistance, and you're going to accumulate long positions into support. However, these are three-dimensional support and resistance levels because they're calculated as a function of price, time, and the probability of significance. Basically, no one else is doing this out there. Now, PPLs are calculated using dynamic optimization algorithms where I look at thousands of different price levels to include Fibonacci's, prior support resistance levels, VWAPs, a bunch of other proprietary mix of things that I'm looking at with the algorithm. And then through this dynamic optimization process, the price levels with the highest probability of being effective, support and resistance levels are picked as the winners. So basically, you rack and stack all the prospective or potential support and resistance levels around current price, and you pick the winners based off of the highest probability of being successful. Now further, given the way the PPL search algorithm works, I'm looking at nested conditional probabilities, and this allows me to do a scan into the future and then back towards the present. Now, this scanning process also helps PPLs serve as tipping points in price action. So if initially they're serving as resistance, for example, in a bullishly trending market, but if you exceed those, in other words, you get above that, then it'll lead to an increased rate of change in probabilities, and it's going to move even faster or accelerate to the next higher PPL. So in other words, PPLs are traditional support and resistance levels. I'm using Bayesian AI optimization algorithms to determine them, and they can also serve as tipping point or acceleration points in price levels if they're exceeded. Quick historical perspective on indicators more broadly. Quick literature review, talk about standalone indicators, and then multiple indicators. So there's a lot of literature out there on this. For this particular presentation, I made it through about 38 of them. And let's jump in and talk about the standalone indicators. So generally, here's the consensus. If you're just using one indicator, whether it's MACD, RSI, moving averages, you're not going to have much success. They're at best a coin flip. The very best are around 53 to 57% accurate, and the worst are well worse than a coin flip. So bottom line, standalone indicators do not work well. Now, can we combine the indicators to improve our results? Absolutely yes. Now, lots of trading organizations out there or money managers have built their own combinations of indicators. And of course, it's proprietary. Why would you tell people about it? But there have been numerous studies done by academics quantifying some of this process. So let's take a look. Generally, what you'll find is, if you look at the circle on the right, that using two indicators is better than using a single indicator, and then using three indicators is better than using two indicators, most of the time. Some of the times, two indicators are all you need, actually. But there's a lot of redundancy when you get above three indicators. So an example would be a Bollinger Band, a moving average, and RSI. That would be a triple indicator. And that improved results. Here's RSI, EMA, VWAP, MACD, right, adds value. In other words, when you start combining indicators, it increases the probability of success. So you can see here that TSI is a good indicator. It matches well with a lot of other indicators. You can add Fibonacci to lots of things, to RSI, to Bollinger Bands, to EMA, right? Again, combining all of these things adds value. You can add Fibonacci to Elliott wave. There's been studies dating back to 2002 that you can combine those techniques. Let's talk about Bayesian methodologies. Now, there's not a lot of Bayesian research professionals out there that apply their techniques to trading in the markets. But there are a few studies, and each of the studies point out that Bayesian learning processes when it comes to trading are actually the strongest or the best at improving results. Because Bayesian is a learning algorithm, and then you combine that with AI, and now you've got a powerful tool. So how are Bayesian PPLs calculated? Well, as I indicated, they're calculated using optimization algorithms on many different price levels. And then a stochastic optimization algorithm is applied on top of that to pick the highest probability of success, support, and resistance levels. Let me show you. So what you see in front of you is a visual representation of the Bayesian learning algorithm. So what I've inputted here is the most current price for SPY, which is the ETF that tracks the S&P 500 index, and dated as of today, which is May 4th of 2026. Now let's let the algorithm begin its work. Now if you notice, the algorithm is basically preparing many different price paths into the future. Also is keeping track of important price levels from before, whether they be Fibonacci levels, VWAP levels, other important support and resistance levels. Now as the algorithm creates these particular paths, it is then running a reverse stochastic dynamic optimization algorithm to then calculate which one of these paths, or several of these paths, will then produce the highest probability or most successful support and resistance levels. So we'll let the algorithm continue to run. And there you go, we're all wrapped up here. We can see here that the algorithm has identified 728, 723, 712, and 706 as your resistance levels on top in green and your support levels on the bottom in red. Now, you may have noticed while the algorithm was learning, it was calculating optimal parameters for standard technical indicators. The top one being parabolic SAR, then TSI, MACD, and you've also can see here that it has an optimal profit level taking level of 0.4%. So in other words, it's calculated the probability of where you should be booking profits, or at least some of your profits. Some people use these indicators or the profit level to take maybe half off the table and then see what the other half does, but that's really up to you in terms of your risk preferences. Now, just as a visual representation, I want to show you that these are actually 3D calculated support and resistance levels. Each one of these cones is a function of price, time, and the probability of success. And some indicators have lower variance, or I'm sorry, I should say some price levels have greater variance versus others. But I'm not going to get into all of those specifics right now, but I just wanted to show you the visual representation of what the algorithm is doing. So after that quick background, you might ask, well, why should I be using Bayesian PPL trading system? By the way, if you've noticed, I've misspelled Bayesian by design. You can see the AI in there. Just want to make sure that you notice that little play on the word. Now, first off, Bayesian methods produce superior results. That's seen in the literature. They provide numerous high probability support and resistance levels, as I just showed you with the visual representation of the Bayesian tool. One thing to keep in mind is this system is autonomous. It's a standalone system, and it's optimized. It removes all biases. So in other words, it is a price action only system. So whatever you're leaning bullishly or bearishly or up or down, it really doesn't factor that in. It only tracks price, and it keeps track of which support and resistance levels have the highest probability of success. That's a really important thing to point out. As I mentioned, the price action only system, I think, is probably one of its greatest values. It doesn't really matter what your biases are. It allows you to trade based off how price is moving. It does help sort out competing viewpoints of respected analysts. So let's say that you've got some analysts that you follow, all right, on a day-to-day basis, and two of the analysts disagree that particular day. One's saying it's going to go up, the other saying it's going to go down. The importance of this system, it doesn't really matter. It's basically just looking at price action. It'll help you sort through that. The PPLs work really well with their own trading systems. So even if you do have a bias and you're bullishly inclined, it'll give you support levels to buy into and resistance levels to take profits into. So basically, PPLs combine AI with Bayesian learning, and that's your true competitive advantage. Now there is a 6-step process by which you might want to consider trading with PPLs. Step 1, determine the ETF and time frame that you want to trade. Then you want to look at the different PPLs. You want to transcribe those to your charting service of choice. You want to load those trade indicators in there, and then you want to place trades as they align. We call that Bayes on. And then you want to book profits or risk manage. So let's go into each one of these in a little more detail. Step 1, determine the ETF. Now I'll be tossing out lots of different types of ETFs for you on YouTube and over at elitewavetrader.net. But let's say, for example, we're working with SPY, SLV, which is silver, and IBIT, which is an ETF for Bitcoin. There's generally going to be two different time frames being offered to you. 30-minute PPLs, which are good for 1 to 3 day swing trade setups. And then also 2-hour PPLs, which are good for, let's call it, up to 2 weeks worth of swing trading. So different time frames. Now, as I just showed you, here's an example of a PPL from several days ago for SPY, and the PPLs were calculated, so I don't have to go over all that again. But what we want to do next is we want to transcribe the PPLs that we calculated, or that were calculated by the algorithm, I should say, onto your chart service of choice. I think this is stockcharts.com, but there's a lot of choices out there. And you can see here that we have the red rectangle and the green rectangle indicating the closest support and resistance levels. And then you have all 4 support and resistance levels on this chart. You can see down below, these are the optimal parameters for each one of these technical indicators. Let's just jump right to an example. So let's say you are evaluating silver, or SLV ETF, on the 30-minute chart time frame. The blue dashed line along the bottom here is the PPL support level that was identified, let's say, several hours before this particular action played out. SLV worked its way lower into the PPL, so we are in the range for a high probability swing long, because support levels generally will hold price action. Now, as the PPL, as the chart, or I say SLV ETF comes into the PPL, we start to then look at the different technical indicators. So beforehand, we don't really care what the technical indicators are telling us because we only act once price action reaches a PPL. Now here we are coming into support, and you can see here that parabolic SAR flipped. The way parabolic SAR works, if you're on top, it's a short status, and if you're underneath, it's a long status. So flipping from short to long, where you have the dot going underneath, is a long signal, especially into a PPL. You also have TSI, which actually went from a short status up to a long status with the black line crossing above the red line. And then you can see here, over here on the MACD histogram, that when we flipped up to a positive bar on that chart, then that also is an indicator of going long. Now, we recommend doing tranching. In other words, if you're planning on 3 tranches to trade this particular setup, then you'll enter 1 tranche when one of the indicator flips to long, and then you'll enter the second tranche when the second indicator does, and you'll enter the third tranche when the last indicator does. So now we're fully positioned, and off we go. Now, if this interests you, then we actually have a personal guide for you. His name's Chuck, and Chuck's going to be posting on our YouTube channel on these setups real time on a daily basis, so you can keep track of how you're trading it and how we're trading it on our end. Here's another example. We have SPY 30-minute chart heading into resistance. Right? And the PPL level is at 692.78. As the SPY price action works its way into the PPL, it's heading into resistance, and we're thinking about taking a short. Again, we throw in the optimal parameters for each one of our trade indicators. And we can see here that parabolic SAR flipped, take 1 tranche, RSI or TSI flipped, take another tranche, and then we can see over here that MACD histogram flipped, and now we're fully Bayes on. And off we go, and off we're running. Now keep in mind the optimal profit-taking levels, and so I would encourage you to take off half at the optimal profit-taking level, and maybe let the other half ride to see if it goes all the way down to the next support PPL, and that would be a much bigger gain. Just an idea. Or take a third off, or take 2/3 off. Right? It's just about having an established methodology, and in this case, grounded in AI and Bayesian mathematics. Example 3, IBIT 2-hour chart. Again, another resistance example. So let's say that you were already long, and you wanted to flip from a long into a short. So you rode this up on the long side. Looks like a nice profit so far. Then you're going to flip into your short position at the PPL at 55.29. Now, again, you're waiting for the indicators to flip. Once these indicators flip, you'll be closing your long swing and getting into a short swing. And let's double up those wins. Big win on the way up, and looks like it's going to be a big win on the way down as well. So risk managing trades, that's really important, and that's a lot about knowing your risk tolerances, and that's really up to you to really look in the mirror and think long and hard about. Do you have time to sit in front of the screen all day? Are you more, does your schedule allow more for 1 to 3 day swing trading, intraday trading, multi-week trading? It's really up to you. But I would highly encourage you to notice those optimal profit levels and know where all your PPLs are at all times, of which you can easily find on the YouTube channel, on our X, or on ElliottWaveTrader.net. Now, when push comes to shove, and we're wrong, and we're going to be wrong because nobody has a crystal ball, nobody's got a time machine. These are high probability setups. They are not 100% probability setups. So with that said, we have to have a rule of thumb to get out. So here they are. We are looking for 3 candle closes against our position. So here's the silver 2-hour chart. We went short. So look at the left side of this chart, for example. We had gone short into this PPL at 47.38. Now, almost immediately, we got a gap against us. And we can see here there are 3 full candles above the PPL. 1, 2, 3. That's a stop out. We don't ask questions. We move on with our life. Let's do one more example. Here's IBIT, which is the Bitcoin ETF. Earlier, look on the left side of the chart. We had gone long into the PPL at 40.80. Looks like things are doing okay. It looks like it was going to be hovering back towards that PPL. You're going to find this a lot of times, by the way. The PPLs have a good time, or have a high probability of where price action will find itself. Now here we are, all of a sudden we get a big gap down, and we have 3 full candles against our position. So we're going to stop out at 38.10 in this example. So what I talked about today is how we can combine AI and Bayesian learning algorithms. Here's a Bayesian trading system. We're really trying to identify these high probability support and resistance levels, and I showed you 6 steps to get yourself into and out of swing trading positions to have the highest probability of success and create that wealth that you've been searching. You can learn more about the PPAs on ElliottWaveTrader.net, or you can follow me, Luke Miller PhD, on X, or my YouTube channel, Luke Miller PhD, where one of my colleagues, Chuck, is going to be putting up daily videos to help guide you through the process. You guys have a great day.